Good morning, welcome to Ainsley News, this 26th of May 2020. Today we're talking gold and Bitcoin, the beautiful thing, and the demise of the USD, discussing Railpal. Real Vision's Railpal every now and then drops a Twitter thread that can capture so much in so little, and we feel compelled to share. As our regular listeners know, Pal, one of the world's best macro traders, has a firm belief we are partway through what he calls the unfolding, where we have to go through liquidation phase, the big sell-off of everything in Feb-March, are now in the hope phase, markets rebounding, people talking about a V-shaped recovery, that he seems to lean towards a June turning point. And then we go into a protracted insolvency phase, as happened in the Great Depression, where we have widespread company insolvencies underneath all that debt. Part of that rampant USD that eats everything before eating itself. Here's his Twitter thread giving a nice summary. The dollar standard. The US economy fell from 40% of world GDP in 1960 to just 25% today. However, 79.5% of all world trade is conducted in US dollars. 84% of all non-domestic debt globally is the US dollar debt. Around 100 trillion of global debts are denominated in US dollars. Total US domestic non-financial debts are $80 trillion and continuing to rise fast. The Fed balance sheet is currently $7 trillion. If this recession is morphing into a global solvency event, which by definition is a slow, miserable grind, not a shock and awe event, which is a liquidity event, then the current strategy of the Fed trying to stave off debt impairment is near impossible, but they will try, and the money printer will go brrrr. But the dollar will continue to rise as demand for dollars rises. This is shown in the next chart. Fed US dollar broad trade weighted index. And that in turn slows global growth, making the dollar shortage worse and the solvency crisis worse as cash flows fall globally, which makes the dollar in even shorter supply. So the Fed print more money to try and replace cash flows via fiscal stimulus. Velocity of monies falls as money is hoarded. All other central banks print more to offset their own systematic strains. Dollar rises since $1 of QE from ECB is worth 4 times in liquidity adjusted terms as $1 from the Fed. So the Fed can't win. And that in turn slows global growth, making the dollar shortage worse and the solvency crisis worse, as cash flows fall globally, which makes the dollar in even shorter supply. So again, the Fed print more money to replace cash flows via fiscal stimulus. Velocity of monies falls. Dollar rises since $1 of QE from ECB is worth 4 times. Repeat ad infinitum until system finally breaks, and then figure out a new non-US dollar dominated currency system. This is not a low probability outcome, but it is clearly not a certainty either. But I give it higher odds than most do. It feels like the next phase of dollar strength is about to start. Yes, I've been saying this for a few weeks. I'm either early or wrong. The chart in the broad trade weighted dollar suggests I'm more likely to have been early. But here is the beautiful thing. If I'm right, gold and Bitcoin go up. If I'm wrong and the dollar falls from here, gold and Bitcoin go up. That is why these are such dominant trades. US dollar is next most dominant, and then bonds to negative rates. As Pal alludes, he is a macro trader. He's not interested in what a trade will do over a week or a month. He's looking big picture and trading on year or 18-month horizon, but knowing it could all start in around June. In his latest Macro Insiders article, he lays out that it would be fitting for the equity market to top out, the bond market to move to lower yields, the indebted companies' share prices to fall, commodities to fall, and the dollar to rise, all in June, matching the hope rallies in the Nikkei Index 1990, the SPX 2001, and the SPX 2008. That's my bet, and I'm sticking to it. I'll leave you with the chart of the Nikkei 1990 and the SPX present day, just shown here. There are a lot of headlines, a lot of Twitter noise, a lot of inexperienced retail investors piling in, and the serious investors giving stark warnings. Buffett, Druckenmiller, Paul Tudor Jones, David Tepper, Howard Marks, Paul Singer, etc. This all has the classic signs of a hope rally. Beneath the surface, things don't quite add up. The market is beginning to whisper debt deflation and insolvency. Filter out the noise and listen carefully. If it gets louder in the next few weeks, get ready to take action. What February and March taught us is when the market tanks and everyone is piling into gold and silver, it's a very crowded space, and our waiting room in particular. And immediate delivery supplies run out. Better a month too early than a day too late might be an apt edit to the well-worn gold adage, better a year too early than a day too late. And that's news for today. Thanks for tuning in. I'll catch you tomorrow. And remember, you can always read all of our news via our website, ainsleyBullion.com.au. We'll catch you later.